Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. Nvidia's blockbuster earnings trigger a Nasdaq surge, but a shadow rotation is underway as smart money flees broader tech. Is this a bull trap or the start of a new market chapter? Second, Nvidia's $500 billion backlog stuns Wall Street, igniting a new sovereign AI arms race. With AI bubble fears crushed, a new, more powerful buyer is entering the game, entire nations. Will this geopolitical gold rush trigger a global GPU shortage and sideline corporate giants? Finally, Semrush skyrockets 74% in a shocking buyout, but the acquirer's stock plunges. This isn't a celebration, it's a critical warning. We reveal the hidden AI disruption tax punishing tech giants and the new M&A playbook that could trigger a wave of takeovers. Pay attention. The market is buzzing today with Nvidia's explosive earnings report, a game changer in the artificial intelligence sector. The Nasdaq is surging up 0.6% as tech investors scramble to recalibrate their portfolios in light of Nvidia's blockbuster results. But don't be fooled by the headline numbers beneath the surface. There's a storm brewing in broader market trends. On November 19, 2025, the S&P 500 edged up 0.4% to close at 6,642.1, while the Dow Jones Industrial Average made a modest 0.1% gain. Yet, the real action is in the Nasdaq Composite, climbing 0.6% to 22,564.23, driven by Nvidia's stellar performance. Listen closely, Nvidia shattered expectations with $57 billion in revenue, a 62% year-over-year increase, and its data center revenue soared 66%. This is your signal for tactical reallocation towards AI infrastructure plays. Here's the deep dive. The Fed's hawkish stance is now the market's reality check. The Federal Reserve's minutes revealed a pivot towards rate stability through 2025, dashing hopes for more cuts. Treasury yields held at 4.12%. Signaling that the easy money era is over. Smart money is now navigating a high-stakes balancing act between growth and valuation risks in this higher-for-longer rate environment. Watch the capital flows. Despite Nvidia's tech rally, the technology sector ETK is under pressure, down 1.6%, indicating investor skepticism. The VIX is ticking up, now at 24.69, a clear sign of rising market anxiety. Valuations are being scrutinized. Mega-cap tech stocks are under the microscope with their inflated P divided by E ratios facing the reality of rising discount rates. I'm telling you, the strategy is clear. Cut non-infrastructure tech stocks and rotate into financials and healthcare today. The financial sector is thriving with net interest margins expanding. Look at XLF, up nearly 3%, with giants like JP Morgan and Goldman Sachs leading the charge. Healthcare, XLV, is another stronghold, immune to cyclicality and benefiting from demographic trends. Sector spotlight, Nvidia soared 4.5% post-earnings, signaling a robust AI infrastructure cycle. Yet, Apple's ecosystem is showing cracks, with its stock barely moving. Target's 3% drop highlights retail struggle as consumer spending shifts towards value over mainstream retail. Meanwhile, Lowe's defies retail gloom, up 4.5%, proving its resilience in home improvement. Good advice makes you rich. Bad advice costs you a fortune. Listen to me, act now. Short term, cut tech weight by 15 to 25% over 2 weeks and rotate proceeds into financials and healthcare. Buy XLF and XLV for defensive growth. Medium term, assume Nvidia's AI demand continues overweight NVDA, target $200, and add AVGO for semiconductor exposure. For risk control, if QQQ falls below 420, halt tech buying, hedge with SPY, puts it 95% strike for advanced investors, or inverse ETFs like PSQ for intermediate protection. Closing thoughts. This market is at a crossroads. The Fed's hawkish shift and Nvidia's AI validation are reshaping the landscape. Don't miss the boat. Align your portfolio with these seismic shifts. Watch the upcoming employment data and the December Fed meeting as critical catalysts. Time's ticking. Let's dive into today's critical market dynamics. Nvidia just revealed it's sitting on $500 billion in orders for its AI chips for 2025 and 2026. We previously analysed how AI spending plans kept getting revised higher. This backlog is the clearest confirmation yet. And this isn't just a forecast. The company just dropped a quarterly revenue number of $57 billion, crushing analyst expectations. It then followed up with a forecast for next quarter of $65 billion, blowing past estimates yet again. This sent the stock soaring in after hours trading. A few days ago, we flagged concerns about pulled forward purchases ahead of tighter rules. This step-up guide suggests demand is still running hot for now. But that's not the whole picture. The real turning point is how this ripples through the entire US economy. We're seeing what some economists call an AI capital expenditure supercycle. So the thing is, this is creating a two-speed economy. The tech sector is booming, pulling up national statistics like a rocket, while other traditional industries might be moving much more slowly. This concentrated boom could mask weakness in other areas, making it tricky for central banks to manage the economy. As we've discussed before, that surge can also widen the gap between reported profit and free cash flow, even as headline growth looks terrific. Now, get this, the performance directly pushes back on one of Wall Street's biggest fears. In response to talk of an AI bubble, CEO Jensen Huang told investors, "From our vantage point, we see something very different. His proof? A blunt three-word statement: cloud GPUs are sold out." We previously noted high-profile skeptics and the idea that some buying could be strategic hoarding ahead of tighter export rules. Tonight's print pushes back on the bubble talk, but it's still worth watching how much of this demand is defensive versus purely organic. Here's where it gets interesting. The real lock-in isn't just the hardware, it's Nvidia's software ecosystem called CUDA. It's not just about the hardware. CUDA is a platform that developers have used for over a decade to build their AI applications. Moving to a competitor would mean rewriting huge amounts of code, which is incredibly expensive and time-consuming. This creates a powerful moat around Nvidia's business, making its dominance incredibly durable. Competitors are, of course, trying to catch up, but with Nvidia holding a reported 94% of the discrete GPU market, it's an incredibly steep hill to climb. We previously analysed how hyperscalers are hedging concentration risk by exploring alternatives. CUDA explains why that transition will be gradual, not overnight. The engine driving this is Nvidia's data center business, which posted a staggering $51.2 billion in sales, a 66% jump from the same time last year. Customers like Microsoft, Amazon, Google, and Meta are collectively expected to spend over $380 billion this year, largely on AI infrastructure powered by these very chips. As we've been tracking, those capital expenditure lines keep marching higher and can squeeze free cash flow even when profits look great. Another metric to watch as this wave builds. However, if you zoom out, you'll see another layer of strategy at play. Beyond these corporate giants, the next major catalyst is what's being called sovereign AI. This is where entire nations start building their own state-controlled GPU capacity for national security and economic independence. Believe it or not, this new wave of customers is far less sensitive to price. For them, it's a strategic necessity. For example, reports indicate Saudi Arabia is launching a $40 billion fund just to invest in AI. This creates a whole new geopolitically driven demand stream that could sustain this boom even if corporate spending slows down. This is where the situation takes a more complex turn. The company expressed its disappointment that it cannot ship its most advanced chips to China. One executive noted that sizable purchase orders never materialized in the quarter due to geopolitical issues. We previously highlighted the dual effect here. It accelerates China's push for domestic alternatives. And if tensions ease later, it risks creating an air pocket in demand. Actually, this is a direct result of US export controls aimed at preventing advanced technologies from reaching China. This provides a real-time test of tech sanctions. The immediate impact is clear. Nvidia's market share for high-end AI chips in China has fallen dramatically. However, these restrictions are accelerating China's push to develop its own domestic semiconductor ecosystem. The pressure is fostering a new generation of local competitors, a long-term risk for US firms that could emerge from this challenge. And as we noted earlier, if controls were to ease after a period of precautionary buying, some pulled forward demand could leave an air pocket in revenues. Despite these headwinds, the company's momentum appears relentless. When asked about the massive $500 billion order book, Nvidia's finance chief made a simple, confident declaration: the number will grow. So the big question is, where does this story go from here? The path forward really depends on two main factors. First, keep an eye on the capital expenditure announcements from the big tech companies. As long as they continue to invest heavily, this AI supercycle will keep driving the market. Second, we need to track the sovereign AI projects popping up around the globe. This new layer of demand could be the next major chapter in this story, potentially impacting everything from global trade to currency exchange rates. And as we've been tracking for a while, watch the gap between reported profit and free cash flow at the big spenders. That's the tell on whether this super cycle is self-funding versus just sprinting on ever bigger budgets. We just talked about the incredible momentum behind AI hardware giant Nvidia, but that boom is creating immense pressure elsewhere. Let's shift our focus to the software side of the equation, where one company's move to stay relevant just sent shockwaves through the market. The most unexpected news in the finance world today has to be the 74% single-day surge in shares of marketing tech company Semrush, marking its best performance ever. The reason? Software giant Adobe just announced it's buying Semrush in an all-cash deal worth a staggering $1.9 billion. The move is designed to boost Adobe's marketing tools for the age of artificial intelligence. The situation presents a fascinating duality. On one side, you have Semrush investors celebrating, while on the other, Adobe's own stock is plunging on the news. Investors are essentially pricing in what some on Wall Street are calling an AI disruption tax on large, established tech firms. This view suggests these expensive acquisitions aren't a brilliant masterstroke, but a costly defensive necessity to avoid falling behind. This penalizes the acquirer's stock in the short term and puts immense pressure on management to prove a rapid return on their investment. According to Adobe's president of its digital experience business, Anil Chakravarthy, brand visibility is being reshaped by generative AI, and brands that don't embrace this new opportunity risk losing relevance and revenue. So when Adobe's president talks about brand visibility being reshaped, what's really happening? The massive 74% premium paid for Semrush signals a fundamental reevaluation of search optimization tools. We are witnessing a major shift from traditional search engine optimization, or SEO, which focuses on ranking high on web search pages, to something new, generative engine optimization. This is all about making sure a brand's information is picked up and cited directly by AI systems like ChatGPT and Gemini in their answers. The industry is betting that being a trusted source for AI will soon be more valuable than a top spot on Google. In fact, some research projects that traffic from these AI models could surpass traditional organic search traffic as early as 2028. This aggressive acquisition follows a major public setback for Adobe. The company's massive $20 billion bid to acquire design software company Figma was scrapped late last year after facing significant regulatory hurdles. When we place the failed $20 billion Figma deal alongside this successful $1.9 billion Semrush deal, a new M&A playbook for legacy tech becomes clear. US and European regulators are heavily scrutinizing large horizontal mergers that consolidate market power. So the new game is smaller, AI-centric vertical acquisitions that are less likely to trigger antitrust alarms. This sub $2 billion price tag appears to be an unofficial safe harbor threshold, which could de-risk and unlock a wave of similar mid-sized acquisitions that have been on hold due to regulatory uncertainty. With its own stock having shed more than a quarter of its value this year, Adobe is fighting to win back investor confidence. Some on Wall Street have grown concerned that traditional software as a service platforms are losing ground in the new AI-driven landscape. The $1.9 billion purchase of Semrush is a direct and strategic maneuver in the AI arms race. It is Adobe's high-stakes bet to reclaim its position at the center of the technology conversation and prove to the market that it will not be left behind. Looking ahead, this move almost certainly sets a precedent. We can likely expect other legacy tech giants to follow Adobe's new playbook, triggering a wave of consolidation among smaller, niche software companies with a strong AI story. For Adobe itself, the pressure is on. The real test will be their upcoming financial reports. Investors will be watching like hawks for any signs of rapid revenue growth from this integration to see if this high-stakes bet was a winning move.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.